I'm with fund manager of the multi-asset funds, James Timpson, to find out more about markets over the last month and what's happening at the moment. James, hi, what can you tell us?
Hi Leo. Well, markets have been a bit bumpy in the last month. The month began with the US debt being downgraded by Fitch. It went from AAA to AA+. However, market reaction to this was very muted compared to when another credit ratings agency, S&P, did the same thing back in 2011. However, equity markets are still down for the month. And it's Chinese stocks that have sort of led this decline because there's been some particularly weak economic data from China. So retail sales in particular were considerably weaker than expected. So Chinese stocks have led the decline, but most developed markets haven't fallen anywhere near as much, while Chinese stocks are down by around 8% for the month. FTSE 100 in the UK, that's down 2.5%, and the S&P 500 in the US, that's down 1.5%. So we've seen some modest declines in the equity market in the last month.
James, what can you tell us about the value versus growth story that we've been hearing about and focused on over the last few months? What's that like right now?
Yeah, so the story this year really has been a big focus on expensive growth companies. So the names like Tesla and Nvidia and Apple, they've been doing quite well this year with all the hype surrounding AI making the headlines. So because of that, value companies have been lagging behind in comparison. But all that's done is it's simply made them even more attractive on a valuation basis. So those expensive companies such as Tesla and Nvidia, they've now become extremely expensive and therefore a fairly unwise investment if you're investing for the long term. So if anything, the funds right now are looking especially attractive because they've got so much good value companies in them and minimal exposure to expensive growth companies.
Yes, and to highlight growth stocks like the Nvidia, you can't just suddenly jump from the value to put a lot of money into these growth stocks expecting to get a short win out of it. You've got to stick to your guns on the value. And we see a lot of charts where over the long term, 30 years, 50 years maybe, that if you take a cash exit 20 years ago, actually now your investments would be a lot higher.
Yeah, that's right. And Jake issued that great article the other day, which shows just how much more money you can make in the long term by investing in the cheaper value companies. So we're absolutely confident that the way we're going right now is the right one.
Thanks, James. Now, the sun's shining down. Everybody knows we've got a fantastic sunny week ahead. Is the sun shining down on any attractive businesses that you might have invested in recently?
Yeah, well, now's really a good time to be buying things. And there was actually some positive news in the UK regarding the economy. The latest figures from the ONS showed that GDP in June grew by 0.5%, which is much more than the forecast 0.1%. And in the UK, we've been seeing lots of opportunities. So with all the turmoil we've seen in the housing market lately, house builders have become very cheap. So the likes of Persimmon and Taylor Wimpey, we've been increasing exposure to them, particularly in the multi-asset funds. So there are lots of opportunities out there. And as inflation comes down and the economy starts to pick up again, hopefully we should see some nice benefits from that.
James, thank you very much. This is September's update. The client seminars are fast approaching. There's a lot of preparation work going on in the background there and invitations will be going out. We hope that you can join us for that and look forward to seeing you if you can. For now, thank you for watching. If you've got any questions, speak to your advisor and we'll get the answers back to you. Thanks very much.